Hi everyone, and welcome back to another episode of turning your portfolio from 10k to 100k over time. So today I had a very interesting discussion with a friend. Right, he was telling me that we should all probably just DCA into the markets, into the indices because there's no point trying to beat the markets, especially against institutions who know everything, has all the data, and has all the resources. Well, I beg to differ. I believe that with my small little portfolio of 10k worth, I can try to beat institutions because sometimes, right, from although they may have the infrastructure advantage, we ourselves as retail investors have many advantages as well, which I would like to share over here. So, contrary to popular beliefs, I believe that a retail investor can outperform institutions. Why? Because we have something that they don't. We have on the ground knowledge, everyday knowledge and observations, and we have the capability to invest in what we know. So one of the biggest advantage that us investors, the everyday investors have is the ability to spot trends early, right? So all these institutional investors, they either they engage their consultants to conduct market study for them, market surveys, which also uses a lot of external data sets and engage a lot of you might do a lot of random surveys, right? And all of this takes up one thing besides money, which is it takes up a lot of time. So trends may come and go very fast, and you have to be there very early on to spot the changes. So, for example, let's say you are a crazy K-pop fan, and you spotted the craze of Labubu early because you're like someone who collects toys, but at the same time you're a big Lisa fan. So if you notice that Labubus started to pick off crazily after Lisa started, appearing with Labubus, right? And if you look at Pop Mart, which is the parent company of Labubu, look at their stock price today, right? Oh, this is the wrong stock, 9992. Pop Mart International, if you look at past 5 years growth, even in 1 year, right, it grew over 420%. So if you're someone who are able to spot this kind of consumer trends early on, you may be able to ride this kind of wave, right, a lot earlier than institutional investors who also depend largely on their quarterly company reports before they started to get the catalyst, the buy signals before they go in. You as an investor already spot these trends early on before the numbers actually report. If you see all your friends started to buy Lavubus, for example, you probably think that, it's going to be a good chance and good time for me to look into Pop Mart, the company as a stock to potentially invest into, right? So that is one advantage that we have. Another example, if you're in the US, right, you started to see that, all the supermarket shelf spaces, the convenience stores, you're seeing a lot of Celsius products taking up a lot of shelf space. And you also notice that a lot of your friends are starting to drink that drink, and you're seeing the shelf space where Celsius is always in is constantly being restocked. There's a lot of empty space, and you see the staff is always there continuing to fill up the space. So this is like very early trends that you could spot before earnings actually report. So you can tell that you can sort of like infer that earnings is going to be good. There's going to be solid growth. So you could have bought into Celsius stock before it popped off as well, right? So how does this work? Number one, observing consumer trends early. Notice a certain product getting popularity among your friends, families, and this could be an early investment opportunities. Number two, recognizing shifting behaviors. Changes in consumer preferences such as healthier eating, sustainable products, or digital payments. All of this can signal the rise of new industries and also new companies that could gain market share quickly. And number three, lastly, is you yourself use the products and services firsthand. So for example, you may you want to lose weight, right? And then you start to see this alternative out there in the market after doing some research of all your weight loss drugs provided by companies such as Hims and Hers, Novo Nordisk, before the boom of the stock, right? Obviously, so you try on this product and you notice that you're losing weight very quickly, and you notice that more of your friends are picking it up and they're losing weight as well. So this could be a good thing for you to. You love the product. The market hasn't moved yet. I think it's an opportunity for you to do deeper research to potentially invest into, right? So besides knowing more stuff on the ground compared to institutional investors, because like I said, they look at their quarterly reports, they buy reports from your management consultants, all of which are lagging indicators, by the way. What you see on the ground is live and predictive. Other advantages. So number one, right, there's no pressure to perform quarterly, right? So all of your hedge funds, your institutions, they have KPIs to hit, right? Or they risk losing their clients. So for example, if a certain hedge fund, they do not hit their growth targets based on their historical performance, right? Their investors may start to get a little worried and may pull their funds out from the funds, which is not good for the hedge funds, because they earn based on two kinds of fee structure, right? Which is your performance fee. Usually after a certain threshold, right, they start to take a cut of the profits, and number two, management fees. So the lower the fund value, the lower the value management fees that they could charge on the notional value. So you as a retail investor, you have no such pressure to perform quarterly, right? You are able to think long term without worrying about the short term fluctuations in the market. So this will allow you to hold on to your investments with conviction and without fear of underperforming in the short term. So all these institutions, sometimes they have to perform quarterly, so they may sometimes take over leverage positions to hit these targets. And if they don't, right, and then that your investors start to pull out, and then this could lead to them selling their convicted bets, which also screws up their entire investment mandates and strategy, right? And number two is the ability to invest in small high growth companies. So a lot of large funds, right, they can't invest in small cap stocks, especially due to liquidity constraints. So for example, you're interested in a company with a 1 to 2 billion market cap, and also, for example, you're Warren Buffett. You want to invest in such companies, but you can't, because when you do deploy capital, you have to just buy up the whole company by itself, and outperformance of that company's stock price may not even move your portfolio at all. So the amount of companies that they could invest into is a lot more limited compared to what a retail investor can invest into. So in today's with today's developments in stock brokerages capabilities, you can invest in anything that you already want, right? Your small caps, your large caps, and even today private companies. You can even invest in SpaceX and etc. with true tokens, right? And so retail investors can capitalize on this by buying undervalued or emerging companies before institutions buy in and drive up prices. Number three, flexibility and speed. So institutions manage a lot more money, so it takes time for them to enter or exit positions without affecting the market. But you as a retail investor, you can buy and sell quickly without moving the stock price or dealing with any red tape, right? You don't have to get your investment committees or your portfolio managers approval before you decide to sell stock. So sometimes when you see something that invalidates your investment thesis of why you invested in this stock, you can just quickly rebalance it by exiting without drawing a lot of unnecessary fees or damages to your portfolio compared to institutional investors. So these guys will take up a lot more time to get out, but you can get out very quickly. And number four, you don't have any restrictions on your investment choices, right? So some hedge funds, they must follow specific mandates, like they can only buy into certain strategies, certain type of stocks, or maybe certain ESG team stock funds, right? They cannot buy any oil and gas companies. But you as an individual, you can invest in anything: growth stocks, crypto, niche sectors, or even highly speculative bets. So this gives you the room to invest in a lot more potentially outperforming stocks, right? And number five, you get your emotional and behavioral edge, if managed well, of course. So institutions may engage in herd mentality, selling during panics together to meet redemptions requests, as mentioned earlier, or they may all just clump up together in buying the Magnificent Seven stock. So, by you as an retail investor, you can buy undervalued stocks during market downturns and hold through volatility. While some of these big funds, right, they can't really hold through all of this. And another thing to note is that these funds, they have to invest at all times. They need to make sure that their capital is 100% deployed, because they're getting paid to deploy capital, right? So this means that even at times where their portfolio managers may themselves feel that it's wrong to be that that risk on and having the whole portfolio invested, right, they have no choice but to do so. But you as a retail investor, you can choose when you want to be aggressive and when you want to be defensive. So for example, I am feeling a little bit like the market is overheated at the moment. I could take some profits out, and at the same time, I could choose to keep a certain percentage of my portfolio in cash. So for example, I can choose to keep up to 30% of the portfolio in cash. So when the market corrects and pullbacks, I can choose to be more aggressive then and deploy more capital. But I think some of these large funds, they can't do this because they're just expected to be fully invested at all times, right? And they can only hedge by like through your options and things like that, right? And number 7 was what I mentioned earlier, which is investing what you know and spotting trends before Wall Street catches on. Number 8 is freedom from groupthink and short-term bias. So institutions, etc., they often follow analyst ratings, consensus estimates, and market trends. But you, as a retail investor, you can go against the crowd and find opportunities where others overlook. So, for example, taking Chinese stock, right, might not be the best example, but let's just use that as an example. If you had bought into Chinese stock back in 2023 and maybe early 2024, where the entire market is thinking, oh, Chinese stocks are crap, there wouldn't be a chance for them to recover because they're losing the AI race. They're getting clamped down by the CCP, things like that. There's no catalyst to respark their property growth markets again. But if you look at, let's take on the golden child of the Hong Kong stock market, Alibaba. So if you have bought into the stock price low at late 2024, you'll be up more than 100%, right? And this where it's trading now. So does this mean that over here, right, it was the peak I would say depression of the Hong Kong stock market and Alibaba shares, because everybody was saying how bad it is. But if you invested then and be a contrarian, you could ride this all the way up. Where even now today there are some jitters about how the investment sentiment on Hong Kong stocks and Alibaba shares isn't still at where it was back a few years ago. But even so, the stock rebounded and you could have easily made 100% return. So I feel that these are the reasons why you as a retail investor can beat out institutions. So if you think otherwise, please let me know in the comment section below, and see you in the next video.